You're about to hear my conversation with Katherine Owen, Vice President and Portfolio Manager with Mackenzie's Global Equity and Income Boutique. Today, we'll talk about the health of the U.S. consumer, the latest views on the Magnificent Seven group of stocks, and what the risk-reward opportunity set looks like outside the United States for global investors. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction and Mackenzie Private Wealth. Today, I'm joined by Katherine Owen, Vice President and Portfolio Manager with Mackenzie's Global Equity and Income Boutique, which manages $23 billion of assets, $8 billion of which is in our flagship Global Dividend Fund. Katherine, thank you for joining the podcast today.
Hi, Rajan. It's great to be here.
Excellent. Katherine, I'm going to get right into my first question. We're talking as we head into the tail end of 2025. When you look at the US economy as well as the US benchmark indices, what's your view of the state of the United States right now as an investor?
My view of the US right now is it's pretty good, right? The economy is continuing to grow. It seems like despite the worries about inflation getting out of control, it seems to be very manageable. And rates are coming down, which should be stimulative to the economy. And the government is continuing to spend for better or for worse in terms of the deficit. But the one big, beautiful bill should be quite supportive of overall economic growth going forward. So when I look at the US economy, it looks like it's on pretty sound footing right now.
Okay, thanks, Catherine. I'm going to ask you a couple follow-up questions based upon what you just shared. My first one, you mentioned the US economy is on pretty sound footing. A big part of that economy in the United States is the consumer. Why don't you take a couple minutes to talk to us about what you're seeing from the US consumer, if it's overall really healthy or if some parts are healthier than others?
I would say that overall consumer spending trends is still healthy. We just saw American Express report and the banks, and all of them are saying that the consumer remains healthy overall. Now, that said, it is a bifurcated consumer, right? Unfortunately, the consumers that are less well off are really struggling right now, right? With higher inflation, costs are going up for basic necessities. So we have a large part of the economy that is not doing so well. But that is offset by, I would say, a minority of consumers, the wealthier consumers that are still doing well. They're experiencing the wealth effect from a strong economy, a strong stock market, and that is really driving overall consumer spending higher.
Now, Catherine, the last time we spoke, I recall you made reference to consumer trade down. Are we still seeing consumers trading down to lower price goods in the same category? And if so, does it look exactly the same or is that continuing to evolve?
You know what? We are still seeing widespread consumer trade down, and that's reported by a lot of the companies, particularly in consumer staples, where they're reporting consumers to be not only trading down to lower price goods, but more and more consumers are trading down to private label goods. We saw Colgate recently report that even in toothpaste, where there is a lot of brand loyalty, partly because these are not high price items. Even in that category, we're seeing more trade down than usual to private label. So it's showing that in terms of the mass market, in terms of the general population, there really is quite a significant cohort that is struggling. On the flip side, you're seeing, like I said earlier, Amex showing pretty good consumer spending trends, but of course they are much more exposed to a much wealthier demographic. We're seeing high-end dining, for example, still continuing to do well. So it really is bifurcated. Not sure what will cause that to change, but hopefully some of the policy that we've seen enacted by the Trump administration is going to cause some relief for the lower end consumer, particularly with gasoline prices. As you've seen in the headlines, he is really, really focused on keeping gasoline prices low. And that, along with perhaps lower mortgage rates that we've been waiting now for many, many years, could help with lower cost inflation for some of the part of the population that really is having a hard time dealing with all of this higher cost inflation that we're seeing right now.
Very good, Catherine. It's so interesting that the trend of bifurcation continues, but it sounds like there's a new wrinkle there with consumers trading down to private label. So thank you for those insights. That's certainly something new for us. I want to stay in the US, but switch gears just a little bit. Certainly lots of attention around the Magnificent Seven. We'll spend a little bit of time on concentration risk in a moment, but maybe compare and contrast how what we're seeing with the Magnificent Seven is actually very different from what we saw at the turn of the century with the tech bubble in the year 2000.
Well, first, maybe I'll just generalize the bifurcation trend to not just consumer, but also to the Mag 7 versus the non-Mag 7, which we hear a lot about. So there is a bifurcation in terms of the stock market between, I would say, the haves and have-nots, and also in terms of what's driving the economy. Companies that are exposed to AI spending are seeing a lot of incremental growth from that. And the companies that really don't have a lot of AI driven exposure are not doing as well. So that theme of bifurcation really spreads not only in the consumer segment, but I would say as much can be applied to the stock market and also can be applied to the economy itself. Now, this leads to the point on comparison of today's AI bubble, which many people are calling it, versus the tech bubble in 2001. I would say one key difference in what is driving a lot of this tech spending today versus 2000 is this spending is actually driven by the most profitable companies in the world, by the most important companies in the world. These are companies that are leaders, that have very strong balance sheets, and generate a lot of cash flow, which they are all using to put towards AI because this is how great an opportunity and risks that they see for AI in terms of it being an opportunity for growth, but also existential risk if a competitor can get ahead of AI. So we're seeing the likes of Microsoft, Google, Meta, Tesla, and now OpenAI through ChatGPT really spending billions and billions, if not $1 trillion, some estimate, in terms of building out the AI infrastructure, in terms of strengthening their own competitive positioning and protecting that competitive positioning.
That's an interesting point. I'm glad you made reference to the exceptional growth rates that we're seeing top, bottom line, free cash flow generation. It would seem that the market is pricing in some pretty high expectations there. Maybe this is the appropriate time to start to contrast that with international markets. Now, for you, at least at the margin, as a portfolio manager, broadly speaking, where are you seeing the most compelling risk return opportunities? Is it in the United States or is it outside the United States?
This is what our team has been spending a lot of time discussing recently is where we see the best risk-adjusted reward for the portfolios in terms of where we want to add exposure. I mean, clearly, we don't want to reduce our exposure to the AI trend yet. It does seem to be on a solid footing, as I mentioned, because this is driven by real cash flow by the world leaders trying to grow this side of the business. And when you're looking at a lot of the data points, you are seeing real dollars being put to work is not vapor, which is unlike a lot of the companies that we saw benefiting from that euphoria in 2000. But today it is generated by real dollars, by real players, and by probably some of the best companies in the world. That said, we are seeing that word bubble come up more and more and more. And what I would say is we don't want to leave this trend too early, but we are cautiously still invested in this trend and hyper vigilant towards any signs that we may see a crack in spending. And one of the most important data points I would say we're watching today is not just data in terms of the actual dollars being put to work, in terms of the dollars that these companies are actually spending, but perhaps more importantly is the market reaction to all of this spending. Right now, the market is saying it's okay to spend and we'll worry about the returns later. If that narrative changes or if that sentiment shifts, that's when I would get really concerned about the sustainability of the spend. Because right now, the CEO of Microsoft, Meta, Google, the market's saying it's okay to spend. But if the market says it's not okay to spend, I think we may get a shift in terms of priorities from these CEOs.
That is a fascinating insight, and I want to thank you for already providing me with the question I will ask you the next time we have you on the podcast, because I will be curious to know if the market's reaction to spending patterns at the Magnificent Seven have changed. Now, I am curious in speaking with other portfolio managers when they talk about or think about the opportunities in international markets. They're actually pretty excited about Europe. Lots of talk about the rate cuts we saw in 2025 from the ECB working their way through the economy, some fiscal stimulus measures that are going from proposal to execution in 2026. And quite frankly, the space is quite underowned. I'm curious how you feel about that thesis. And related to it, some of these international markets have done quite well in 2025. Do you think this is a trend that could not just prove durable, but maybe accelerate in the next 12 months?
I think it could. In terms of incremental opportunities, I mean, definitely Europe as a region is a place that we are finding more opportunity because, like as you mentioned, for the first time in a long time, it looks like a lot of these colonies are on the verge of growth. And that's supported by a lot of fiscal spending, particularly in the German economy, where the government is really focused on improving growth for the German economy. So we have exposure to Europe. Actually, some of the stocks that we own in the portfolio that have been the best performing year to date are actually based in Europe. So BAE Systems, which is a defense company based in the UK, has been one of the top performers of the fund. And that's because it's been benefiting from higher expected defense spending by European governments. And BAE, being a leader based in Europe, is going to be a big beneficiary of that trend. Another top performing stock of the fund is actually Deutsche Börse, which is the operator of financial exchanges in Europe. So that is a natural beneficiary of higher volumes. More and more people want to invest in Europe. They are really a toll road for capital markets in Europe, and they've been a big beneficiary of higher interest, higher volumes in the European market as well.
Very interesting. Now, I'm just going to switch gears a little bit. We've been talking a lot about markets and risk return profiles. Let's shift over to portfolio construction. Portfolio construction, though, from your seat, how do you manage risk in the portfolio? You're looking at potential concentration risk in the US. You're looking at, I'm sure in some parts of Europe, value traps. But at the end of the day, you're always looking for the best global companies to invest in. How are you managing risk though when you put that all together?
Well, we're managing risk today like we've always managed risks, which is trying to get the best risk-adjusted return for our unit holders. And very importantly for us is to have that downside protection in the portfolios so that if the market goes down, our goal really is to hold up better than the market and hold up better than the peers. So achieving a portfolio that's lower volatility than the market with better downside protection than the market, but also able to keep up with the market when times are good is really our ultimate goal. And when you look at our track record, that's really what we've done over the last decade. Now, looking ahead, as I mentioned to you, we do have exposure to some of these, what I would call now momentum stocks that are really exposed and really benefiting from the AI trend. We still have exposure to that because we still believe that there is a long runway of growth. That said, expectations are getting very, very high. Some may say frothy. So, as I mentioned before, we are in these stocks with cautious optimism. From a portfolio construction perspective, We really want to have still one foot in these very high growth stocks that are benefiting from a big megatrend. But on the other hand, we really want to think about protection on the downside. So we really want that ballast in the portfolio through more defensive sectors, through more defensive businesses. So we still own a lot of, basic necessity stocks like the Coca-Colas of the world. We own tobacco companies, which is, whether or not you like it or not, one of the best businesses in the world, and where we are finding a lot more opportunity today, not just in Europe, but really in healthcare. Healthcare for us serves a lot of different purposes for the portfolio. Number one, it provides more defensive, non economically sensitive exposure. And number two, it provides more asymmetric risk reward. So for us, when we're looking at healthcare and where we're finding opportunities, 3 months ago, we saw healthcare as a whole trading at multi-generational low valuation levels versus the S&P 500. People did not want to invest in healthcare, which is why we actually wanted to look at healthcare because we thought a lot of the concerns regarding healthcare was transitory. Fast forward today, over the last month, healthcare has actually been one of the best performing sectors for the simple reason that what caused this sector to be uninvestable 3 months ago is now investable because it's perceived that a lot of the doom and gloom, a lot of the fears regarding this sector in terms of regulation is alleviated. So today, we have a sector that is still out of favor. I would say people are looking at it more favorably because it looks like the worst case scenario in terms of harsh regulation is not going to be materialized. And when you're looking at the companies in this sector, they are still very, very innovative companies. They're inventing more and more drugs that can save more lives, that can improve the quality of lives. And when you think about AI, this is a sector that would benefit from AI because AI can make R&D, can make drug innovation so much more efficient, so much more productive, and these stocks are really not priced for that potential benefit.
Excellent. Thank you, Catherine. I only have a couple of questions left for you. My first one is when you think about risks in the market, I asked you about how you think about risk in the portfolio, but if you look at investors, what do you think is the one risk they're not paying enough attention to as they build their own portfolios?
Well, I think one risk is recency bias, right? Because I think a lot of investors think that what worked best over the last 5 years, maybe over the last 10 years, is going to be what works best over the next 5 and over the next 10 years. And when you look at history, that's never the case, right? So I think when you're constructing a portfolio, as always, and maybe more so today, it's so important to be diversified. Not only diversified by country, but diversified by sector, by style, value versus growth, offensive versus defensive, and maybe even by asset category. So, as I'm sure we've all noticed, being Canadians, the surge in gold this year has been spectacular, right? And when a stock or an asset goes up a lot, there's always a narrative that supports it, right? It went from being an inflation hedge to a fiat currency hedge. And now, when a stock or an asset gets momentum, it's something that propels itself, right? Momentum generates more momentum. And because a lot of people are noticing that gold has gone up so much, they're thinking, oh, I don't want to miss out. So now they're piling in. I'm not a gold expert, but what I can tell you is that when we're thinking about portfolio construction and thinking about diversification, we actually did buy a gold miner because we wanted to diversify our portfolio and gain exposure to more and more types of different asset classes.
Catherine, last question for you. In our prior conversations, we have talked about reforms in Japan. We haven't spent a lot of time talking about Asia in our conversation, but where are we with regards to corporate governance reforms in Japan and also more shareholder friendly actions? I know you've spent some time in the region over the last 12 to 18 months meeting with companies in the portfolio. So you've been on the ground. What's your perspective?
Yes, I just got back from Japan a few weeks ago, along with Darren and a few other members of the team, precisely to investigate this viewpoint, Rajan. And what I can tell you is that corporate governance is getting better in Japan. We're seeing it, we're hearing it from company management, and it's not just words, it's actual actions. They are improving the return profile of these companies and they are becoming much more investor oriented. And that's showing up in terms of how they run the companies, in terms of how they manage companies, and in terms of the improving earnings profile, growth profile of a lot of the companies that we own or even not own in the portfolio. So, what I would say is corporate governance improvement in Japan is real. I think it's durable. We think there's still a lot of opportunities to make good returns in the Japanese market.
Excellent perspective, Catherine. Always most valuable from somebody that owns the companies from the region and also spends time boots on the ground in these locations, meeting and interacting with management as well as their customer base. I think that's all the time we have today for our conversation, Catherine. I wanted to thank you for joining the podcast, and I am already looking forward to having you back again sometime soon.
Thanks, Rajan.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.